Good morning. This is the Saxo Bank morning call for Tuesday, September 11th. Yesterday being Monday, it wasn't a huge amount of market activity, but do have things going on in FX. I'll be focusing especially on sterling. The dollar a little bit quiet here, but I'll be focusing on quite a big moves in sterling linked to Brexit news and on the Russian ruble. And Peter, I know there's plenty going on in equities, especially emerging markets.
Yeah, we were down actually 1.5% yesterday in dollar terms. So we're seeing further declines here in Asia. A little bit more mixed. Japanese equities a bit, but if you look at the Hong Kong and the Chinese market, we're down again.
Yeah. And then I'll tell you, I think your focus is on the U.S. yield curve. We talked yesterday a bit about these average hourly earnings coming out Friday. We're seeing that short end of the curve coming up. Is that your focus?
Yes, absolutely. I'm going to look at the yield curve and I'm going to focus especially on the 2 years that is rising faster than the 10 and the 30 years.
Right. Great. So yes, the big mover in the G10 FX space, at least, has been sterling. We've got this news yesterday that the EU's Brexit negotiator Barnier is saying that some kind of deal could be possible within an 8-week time frame, and sterling got quite a boost on this. I think I tweeted out earlier this morning, though, an interesting commentary piece saying this all could lead to a terrible constitutional crisis in the UK because any deal is likely to be along the line of the Chequers deal, which there are many conservatives that would vote against. You'd have to see significant support from the labor side. Is that likely or possible? Very interesting. Let's look at a chart here of we've got sterling Swiss, and the one reason I put sterling Swiss is we got a couple of things in this pair. You see the tremendous move yesterday, up a couple hundred pips from that 125 to 127 plus level after a 10% slide from the spring. The combination of those Italian yields dropping, the apparently progress on the budget side in Italy leading to much lower BTP yields. That 2 years dropped from something like 150 basis points to more like 80 basis points. That's seen an improvement there. We saw a huge bump in the Italian equity market as well yesterday.
Yeah, it was 2.5%, so that was a significant move in Italian equities.
And a significant outlier because we didn't see that move mimicked across Europe either.
Exactly, it was an outlier, and I have an interesting chart and some commentaries between the link between the two Italian markets later.
Right, so anyway, the sterling Swiss, the combination of that Italy story sort of waning in terms of the threat to the EU existential risk, also any Brexit news that's positive, also feeds into, even though euro sterling is down, it feeds into a more positive euro. So you saw euro Swiss really rebounding very, very strongly from that 112 level. We talked about that 112 level yesterday, and you see that. And then finally on the FX, we have a chart here of the Russian ruble versus the dollar. Another extension higher. This has been one of the weakest EM currencies. A couple things going on here. Some traders treating this as almost like a Turkey story with this potential interference of the central bank. We saw recent signals being sent by Nabiolina, the central bank chief, that she intends to hike rates, and the political leadership arguing that we need to be very easy on credit because the Russian economy needs support from a lower interest rate. So the market seeing this as a setup similar to that whole situation that got the Turkish lira into so much trouble. The structure is not quite there. We also have the added risk of geopolitics. We have this very intense situation in Syria and Idlib where the risk is of a hot confrontation between the U.S.-backed and Russian-backed forces there. This could lead, of course, to indirectly to some sort of new sanctions on Russia, and that would be a massive additional risk to the ruble. Not seeing the credit spreads stretching wider in terms of Russian dollar-denominated bonds. They're close to the highs for the cycle, those spreads versus U.S. Treasuries, but not at new highs versus, for example, South Africa, which are at new highs and providing plenty of pressure on the South African rand. So, Peter, we have a couple of things here on the emerging markets, especially China, which a lot of gravity from China in emerging markets, and they're basically pegged at the lows, right?
Exactly. So China is basically the center of the universe, if the universe is defined as the emerging markets. Everyone evolves around that. And it's the backdrop you just said with Russia and South Africa. We have the Turkish situation. We also have the Argentina story. It's still filtering bad sentiment and worsening news sentiment into the emerging market. That's why we're seeing Chinese equities continue to be pressured. So if we go to the chart as we just had up for a few seconds ago, I've drawn sort of the blue line here, which I think is really the hard line in the sand for the market. So it's basically that double lows from more than a month ago, and then that low we had print in 2017. I think if we go below that in the CSI 300 index futures, I think the level is 31.88. Then I really think that we could be in for an ugly situation in China. So we have to watch that. And then we still have that technical breakdown we're seeing in the technology sector. So we know the Chinese technology sector is very overvalued compared to US peers. And one of the names are obviously Tencent, and one of the biggest index weights. And if you look at this chart brought with me today, you can see here that it's fast approaching this rising trend line from the two lows back in 16 and 17. It's around 10% further down from here. And Tencent just announced this morning that they are issuing new buybacks. So I think that's a very firm signal that they think it's cheap. I don't think it is cheap from a valuation perspective when you compare to everything else, but I think they really want to send a strong signal to the market to support it.
Wasn't Alibaba, we talked a little bit about Alibaba yesterday. It was a bit of an outlier on the downside. This is not being taken as good news that Jack Ma wants to do some kind of Bill Gates-esque retirement, supposedly. The stock was down something like 3 or 4%.
Exactly, and now that you mentioned Microsoft, I mean, Microsoft is a pretty good example that where you had this leading co-founder that left the company. There's always this leadership vacuum afterwards, and Jack Ma was the instrumental leadership figure for Alibaba. So, if we move on to the next theme, I want to highlight Italy as well. You mentioned it, John, and I know, Tia, you also have some comments on this in the Italian yield curve. But we had a 2.5% move, and as you can see, I put in the blue line. So if we play with the thought, the thinking that there is a linear short-term relationship between the yields and the equity market, then where the 2-year yields have moved to right now on an average over the past 2.5 months, that suggests that actually the Italian equity should be around 5 to 7% higher if that relationship holds. So either the bond market has carried too far, too fast, or maybe the equity market actually has some room to upside. This is not a trade recommendation per se. I'm just observing some divergence between those two markets.
Altia, what signals are being sent that's got the BTP's yields retreating so quickly? Are they just sending sort of messages that they're going to be responsible in the budget, or what's the
yes, so these have been the messages that have been coming out of Italy, and especially the Northern League leader Salvini is the one that has been saying that he's not willing to go over the 3% deficit target. But I still think that the Italian yield curve is very sensitive to headlines, and although now we see some signs of improvement, it continues to be sensitive. We have one of the leaders saying that he's not willing to go over this target, but we don't know exactly what other politicians are going to say. So I believe that investors should be cautious.
And then your chart focus today was on the U.S. yield curve. Now, we don't have the actual curve on this chart you brought with you, but it does show how the 2-year has risen so much faster than 10-year and 30-year, where you can see the various colors here. What is it going to take to get this longer end of the curve to achieve liftoff, or is it never going to achieve liftoff?
Yeah, well, the thing is that with this graph, I wanted just to show that the 2 years is rising much faster than the 10 years and the 30 years. And although now we have some improvement on the news that we get, on the situation and the market sentiment in the emerging markets, and we see the 10 years being a little bit softer, still the 2 years is rising. And I believe that what is happening here is that as interest rates rise, there is more pressure on the U.S. corporate markets, and especially on the U.S. high-yield corporate space, which I believe it's a bubble that is going to burst. Interestingly enough, the high-yield U.S. corporate space is the only one that returned profit results since the beginning of the year until now. All the other bonds instead have been repriced.
So similar to the equity markets, where the U.S. has outperformed, so the high yield space in the U.S. has outperformed as well.
Yeah, exactly.
Okay.
So, and also interesting enough, what we have seen last week with Tesla pricing in the low 80, which is like a stressed bond, the yields barely touch 9%, which is not typical of a high yield distressed bond. So for sure we are going to see some repricing as more issues come. Some concern comes surrounding refinancing.
Well, that is a classic indicator leading into any broader sense that we're heading into recession. And the junk yield spreads that an indicator I track, it's not quite at new highs for the cycle, but it is moving in the wrong direction, so that'll be interesting. So we'll close out today with our calendar. We have a couple of interesting items we've added for this time around. If you look at the red, I'm not so interested in today. We do have some UK data out today that would, in past cycles, I think get some attention, but we're looking at headlines on Brexit more to drive the action in sterling. The interesting point for this week, as we pointed out yesterday, could be the ECB, although we're not expecting much from them in terms of guidance. We're talking about the final taper, but it's the U.S. CPI data for the U.S. dollar. And then further out, it really is this Brexit focus, massive headline risk. UK Prime Minister May is going to meet with the EU at a summit September 19th to 20th. And then we have this Conservative Party conference, which is the really interesting one. Again, look at that article I tweeted out earlier, William Hay commenting on this. Do we have a massive revolt on the UK Conservative side against whatever deal, if it's too much along the lines of the Chequers deal that May is in favor of and does not offer, in the Conservative members' views, sufficient sovereignty for the UK in a post-Brexit environment. So that'll be very interesting. But for now, that's it for us today, and we'll be back tomorrow with another edition of the Market Call, Morning Call.